Welcome to the IREL podcast. Are you sick and tired of real estate gurus pitching their next pre-construction deal only to find out years later they were completely wrong? Worried the next overseas conference you spend thousands to attend will only be used to sell overpriced lots and deserted developments? Join thousands of other international real estate seekers who are looking for their place in paradise without the sales pitch. Straight from your host, Taylor White.
Hey, podcast listener. Welcome to the Overseas Property Insider Podcast. I'm your host, Taylor White. In just a few moments from now, you'll be hearing from an incredible resource that has been involved in the mortgage business for decades, and I can't wait to share his valuable insights about the history of personal credit and its correlation to mortgage loans. Mortgage financing is his thing, and connecting my listener base in over 70 countries with your real estate is mine. If you're a homeowner, agent, or developer, and you want to showcase your properties to my worldwide audience, then you should listen up. As host of the #1 ranked overseas real estate podcast in iTunes that has been downloaded thousands of times by listeners in over 70 countries, they all have one thing in common: an interest in seeing your overseas property. Head on over to irelpodcast.com/list and get started today. We've had a series of awesome guests lately pertaining to credit and credit scores with Mike Greiner, mortgage information with Tim Lucas, mortgage options with Ellen Davis, and we are now filling in any gaps with how all these correlate when I sit down and speak with Marty Goldstein, who's coming to your earbuds from sunny Calabasas in California and the GEM headquarters. Stick around with Marty and I, and you will learn the history of credit scoring, the year it started being calculated and tracked, and what lenders did prior to such famous names as Experian, TransUnion, and Equifax. Reveals what the 5 main factors of credit scoring are, and then how important all of these are in relation to your final credit score. Uncovers the different levels of credit scores in relation to mortgage interest rates, and you may be shocked at how little or how much the difference is, and much more. I was so incredibly impressed with Marty's understanding the real correlation of credit scoring in relation to mortgage loans and obvious passion for his clients and business that we go into further depth and details with mortgage loans in future episodes. Instead of telling you more, let's join Marty from the GEM headquarters from sunny Calabasas. Marty, what's going on? It's Taylor White. I'm excited to have you on the podcast today, straight from GEM Mortgage headquarters, so we can get to know you personally. Tell us a little bit more about yourself.
Taylor, first of all, I wanted to thank you for this opportunity. I love doing this, and I'm very excited to talk to you, and hopefully we can help out some of your listeners. I am a mortgage banker, meaning I do home loans, and I've been in banking since 1990. Was in the private banking world with some of the big banks that we all know the names of, and then some smaller banks. And then in 2001, I jumped into mortgage banking. And for the last 13 plus years, that's what I've been doing, is helping people finance their properties, their dreams, etc.
So, Marty, I know that you're a mortgage banker with GEM Mortgage. Can you talk more about your business and then maybe which states you guys are licensed in?
Absolutely, Taylor. As a mortgage banker, that means that we have relationships with 20 different banks and or investors, and we underwrite and then sell off to them directly, as opposed to a broker that goes out and submits it to 5 or 6 different places. We have a much, much greater control over the process. GEM is a mortgage banker that is based on the West Coast, and we have offices in California, Washington, Oregon, Arizona, and actually now Hawaii. So we have about 60 plus offices throughout the Western U.S.
Love it, Marty. And then just as a follow-up, you are a mortgage banker, which is different than a mortgage broker. And correct me if I'm wrong, but a mortgage banker means it's all in-house. So it's your own staff, it's your own loan products, it's your own underwriting, it's your own everything. So technically, you guys could get the deals done faster.
Absolutely, without question. That being said, we do have the option to broker when there are areas that we cannot deal with directly, and then we will go direct and broker to a particular bank institution.
Love it, Marty. So this is an overseas real estate podcast where I speak with many house hunters, international, live here, buy this alums about buying real estate in places like Mexico or Costa Rica or Spain. With overseas mortgage options limited, many listeners are turning towards getting a mortgage refinance on a property located inside the U.S. and then using that cash for their overseas purchase. Of course, to get a loan with a great rate and term, we need to understand our credit and our credit scores and how it relates to obtaining a mortgage. So with you, I would love to deep dive into our credit reports and what it means to get a mortgage loan. So Marty, first off, can you talk more about the history of credit scoring?
Absolutely, Taylor. We've been in an evolutionary period, if you will, since the 1960s, where these certain algorithms were created to establish the repayment history of borrowers, therefore determining the risk to the lenders. And over this last 50 plus years, there has been, like I said, an evolution, and it is down to an exact science. However, no one will tell us what that science is specifically. And quite frankly, it's always a moving target, but there are certain categories that we do need to focus on.
Hey, Marty, just curious, as a follow-up, what did we do previous to 50 years? So if it's just the last 50 years or so that we have credit reports and credit scores, what did mortgage lenders do before that?
Well, they would have gone and looked at tax returns and cash flows and determined an ability to repay there. However, unless they'd done business with these people previously, they had no history. They didn't know what they were expecting. They would require, in most situations, a greater down payment, so the lenders would have less risk, and they probably would charge slightly higher interest rates because they didn't know. So the advent of using the credit scoring systems, I think, has probably benefited most of us during this last time frame.
So, Marty, I know it's completely obvious to you doing this day in and day out, but why is our credit score so important when obtaining a mortgage loan?
Bottom line there, Taylor, is kind of dollars and cents. The better that your credit score is, the better rate and terms you're going to get. And quite frankly, also, the better the score, the easier it is to make a decision. And the better the credit score, that then has the ability to be a compensating factor for other factors in a file that may have a perceived weakness.
So then, Marty, I know that there's 5 main factors of credit scoring. Can you talk more about what these 5 main factors are and then how important each one is?
Absolutely. Taylor, the first one is actually your payment history. And as far as we can tell from the information that is released to us, about 35% of your credit score is made up of payment history. Okay, and what does that mean? Basically, how have you handled your credit over the time frame that you've had it? And we're talking about stuff like late payments and charge-offs and medical collections and things like that can hurt. And obviously, your good credit, as you paid on time, goes into basically 35% of the credit score makeup.
And then why don't we roll in maybe to the second one, which, correct me if I'm wrong, I think it's outstanding credit balances.
Correct. And this is the outstanding credit balance is an approximately a 30% impact on the overall score. And what this means is there's a comparison, there are ratios to the amount of credit that you have available to you versus how much debt you have against that credit. And that is, according to these credit scoring algorithms, is very, very indicative of how you're going to perform. So I'm just going to use a very, very basic example. Let's say that you have credit lines that are approximately $10,000 worth of lines, and you have $9,500 out on those various lines, okay, that's going to be considered a higher risk. If you're in that, let's take a different client, also with a $10,000 limit or credit available, and they have $3,000 outstanding. They're going to be a much, much better credit risk or a lower credit risk, and that therefore will create a higher credit score based on that. So the amount that you have outstanding compared to what you have available is a very, very key factor here.
Perfect, Marty. So we talked about payment history, which is about 35%, give or take. We talked about outstanding credit balances, which is about 30%, give or take. Now, why don't we hit on credit history?
The credit history, Taylor, is bottom line, how long have you had credit? And, you can look at two different people that make the exact same income, and and they have some of the same credit outstanding, but you have someone that has a 30-year credit history, and then you have someone that has a 4-year credit history. If they've maintained their credit essentially identically, the person that has had the 30-year credit history is going to have higher credit scores via the algorithms.
So then, Marty, why don't we touch on the fourth aspect, which is type of credit? So maybe explain what type of credit means and then kind of different types of credit that we can get.
Absolutely. Taylor, the types of credit make up about 10% of the credit scores. And when I say types of credit, I'm talking about auto loans, a Visa, MasterCard, store credit cards, mortgage loans if you're already a homeowner. The mixture does make a difference. If you are someone, don't mean to pick on young people, but let's just say we have a 22-year-old that maybe has a 3 or 4 year credit history, but their credit history is completely concentrated in store credit cards, okay? Nordstrom, Bloomingdale's, whatever it is. If that is all their credit, they would have a lower credit score than someone that has a couple of those department store credit cards, a car loan, or a Visa or MasterCard. So the broader the perspective, the more things, and I don't mean to say the more things that you have, but the broader the perspective, the better to aid in increasing credit scores or to have higher credit scores.
Love it, Marty. So why don't we touch on the fifth aspect, which is one that I know gets a lot of people in trouble, and that's inquiries. And correct me if I'm wrong, Marty, I'm going to cut in again, but I know that there's something known as hard inquiries, and I guess it would be soft inquiries, but a hard inquiry is done like if I go online right now and I run my credit because I want to get a credit card, and they run the credit. So that's a hard inquiry. And a soft inquiry might be one that different credit agencies are doing without me knowing it to see if they should send me great offers.
That's correct. And the soft inquiry could also be a existing company that has that you have a credit card with, and they may be seeing some unusual activity, and they go ahead and run your credit internally. So that's the soft inquiry, because they're looking to see what's going on with the rest of your credit. And inquiries, a lot of people are afraid to have their credit run because they think they're going to get hit each and every time. And while this is true or can be true, people don't necessarily need to be afraid of that. And I don't think most listeners know this, but there are different types of credit inquiries. The one that I would run for a mortgage loan is going to be different than a department store is going to run for their credit card, and an auto dealership is going to run for theirs. They're going to have different scores. They look at a little bit different criteria. But the bottom line here is you do want to limit your inquiries, and especially within a 6-month time frame if you're looking to do a purchase or possibly refinance your home.
Perfect, Marty. And then just as a follow-up, are these 5 main factors the same with the 3 main credit agencies, which, correct me if I'm wrong, I think are TransUnion, Equifax, and Experian, or are they different for each one?
Here's the way I can answer that the best, Taylor. Maybe. They each run on their own different computer algorithms. They are, I'm going to say that they are essentially the same. Typically, we don't see when we run a credit report and we see 3 scores, they're really not going to be all that different. So based upon that information, as long as the exact same information is reported to all three of these credit bureaus, the scores are generally pretty consistent. So based on that, I would have to assume, because they don't make it public, I'd have to assume that they are looking at the same criteria and give about the same weighting factors to each.
So, Marty, why don't we jump on over to the mortgage side of things? How does a low credit score affect my interest rate?
Very simply, the lower the credit score, the greater the perceived risk, and therefore the higher the interest rate. And I just ran a quick example, Taylor, and this is on a $400,000 loan, and I'm doing it at 3 different credit points. Okay.
Yeah, please.
The first one is a 620 score, which we would take the middle of the 3 bureaus, which is considered a okay score. Not a good score, not a great score, okay, bordering on not so good. And I don't, I'm just, it is what it is. I'm no judgment here. This is what we're dealing with.
Marty, I told you, don't say what my credit score is over the phone. My gosh.
Hey, Taylor, I apologize. I truly do. Okay, so $400,000 loan. We're going to, and I'm not quoting rates. I just want to make that very clear. I'm giving you an example of what things would be based on the different credit scores. So with a 620 credit score on a $400,000 loan, I would be able to deliver an interest rate of 4.75 on a 30-year fixed loan. Okay. That monthly payment is $2,086. Okay. If you go up to the next level, which is a 680, which is considered a good average score, the interest rate is 4.5%, so a 0.25% difference, and there is a payment differential of $60 a month. Okay, it's not a significant difference, but it is a difference, and when you do it out over 360 months, it's very significant. If you have what is considered to be an excellent credit score, a 720, the exact same loan, you're going to get an interest rate of 4.25%. Okay, this makes the payment $1,967 a month. All right, so from top to bottom, from a 620 to a 720 credit score, you're looking at a monthly difference of $120 a month. Okay, people might look at this and go, $120 a month? I can afford it, no big deal. My credit's not that important. Let's put it in a little different perspective. Okay, in California, which is where I'm based, the average home is kept for approximately 7 years. Over this 7-year time frame, that $120 or $119 difference per month comes out to close to $14,000. I don't know about you, but $14,000 in my pocket is a whole lot better than paying that out to a mortgage lender. But again, that's my perspective. So the credit score does make a difference, and especially over time.
Marty, that's fantastic. And I'm just curious, as you've been doing this for quite some time now, how does the rate differ now than it did, say, 7 to 10 years ago? Like I know, 620, 680, 720. Are those scores higher or lower that you need today versus 7 to 10 years ago?
They're not necessarily higher than they used to be. The numbers that I've been doing this for 13 years in the mortgage space specifically. And over that time frame, these numbers have stayed relatively consistent. 720 has always been, if you're a 720 or above, that's excellent. 680 is good, very average. 620, you're getting down towards an area where there's greater concern or greater risk or perceived risk, actually. So it's not so much the credit score. Mortgage lending has changed significantly just in the last 5 or 6 years, and even the last 18 months. The credit scores still drive the interest rate that you're able to get, but there are other factors that come into play. And if these other factors may be perceived as weak, you having that better credit score can help compensate and make the difference between getting a loan or not getting a loan. So that's also a very, very important factor, Taylor.
So then, Marty, as a follow-up, the credit score of, let's say, 620 or 680 or 720, just as examples, that will put you in a bracket. But then, of course, you have to show plenty of other documentation along with those credit scores. And if your credit score is lower, you probably have to show a lot more documentation. If your credit score is higher, then you might show less because that just shows that you have a good history. Is that correct?
That's correct. The documentation portion of what we're dealing with today is very, very different than it was 10 years ago. But what you're saying is correct. You will have to show less documentation based on your perceived ability to repay. Okay. And it is going to vary, quite frankly, because we can go to different lenders with higher credit scores that will require a little less documentation. But like you said, if we do have a lower credit score, then yes, you will get examined much more closely. I think that's probably the best term for that.
So then, Marty, staying on the mortgage side of things,
yes.
And I know that you guys do a lot of things in-house. How does an underwriter view credit scores?
The majority of what we do in-house is basically underwritten by automated underwriting systems. These are tied to Fannie Mae and Freddie Mac, and they have created these. And the bottom line is you're putting in your credit history, your income, the property, everything, and it is making a calculation. That doesn't mean that an underwriter doesn't have anything to do or say about this, because there's all kinds of different interpretations and how each loan is presented. So I just very, very simply, if you're dealing with a 720 credit score and we get this automated underwriting approval back and it just says, show us one pay stub and last year's W-2. Okay. When an underwriter gets that, that's nice and easy for them to do. Takes no time at all. Very, very quick. It is what it is. However, if you're dealing with a 620 credit score, it may come back and say, all right, well, we need to see the last month of pay stubs, the last 2 years W-2s, and the last 2 years of your 1040 tax returns. Okay. Then there can be other questions that arise based on what is in that documentation. So yes, the credit score definitely has an impact on how the underwriter views the file, how the automated underwriting systems view the file, and therefore the decisions.
Marty, I hate to jump around on you, but you're extremely intelligent and just things are kind of coming to mind. So talk to me about ways in which we can dispute errors on our credit reports.
Okay. What I like to do with the majority of our clients is to get them well before they think they're going to be buying a house or refinancing. What we like to do is try to get them as prepared as possible to put them in the absolute best position they can be in. So ultimately, I would like to talk to Taylor as a prospective buyer about 6 months out. I would sit down with Taylor. You're going to tell me, oh, I'd like to spend about this much. And, we'd figure out what you'd be looking for. We would run your credit report. We would review the credit report with you. The bottom line is on over 50% of the credit reports, there's erroneous information. Okay. Some of it may be misspellings. Some of it just may be completely incorrect and something that's attached to your credit file just because someone has a similar name. And yes, it should be tied to a social security number, but that's not always the case. So what we like to do up front is review that with the client, make sure that the credit report is as accurate as can possibly be. And if there are things on there that are incorrect, we then have the upfront time to deal with those. So that's my approach. That's the way I like to do it. Unfortunately, it doesn't always work that way. Sometimes you get a phone call and people say, I've already put an offer in on this house. Okay, got to close in 30 days. And you don't have that option of going in, analyzing the credit, seeing what you can do to make corrections or improve scores.
Well, I love that. So we talked about people that have credit or sometimes that have credit that they don't like very much. It's not very good. What if it's people, Marty, that don't have any credit? What should they do?
Okay. People that don't have any credit. I don't want to say way back when, but let's just say several years ago, you could do something called alternative credit, and you still can today to a certain extent, but it's not as prevalent as it was. And you can essentially create a credit report, if you will, by going to someone's insurance company and saying, okay, they've been paying us monthly, and you get something from the insurance company. You show canceled checks and or money orders paying this monthly. You can do this with utility bills. There are ways that you can go and help create a credit report. If someone says they need to buy a house in 6 months and they have no credit, quite frankly, that's going to be tough, okay? Because you do need to work in some sort of credit history. And that credit history can be as simple as, going to, a Walmart or Kohl's or whatever it is and getting a credit card. But the one thing I need to caution you and your listeners on here is, remember, we talked about the length of the credit history and how that goes into a credit score. If all of your credit is brand new, that's not going to bode well for the credit score. Yes, there will be a 6-month payment history, a 4-month credit history, whatever there's going to be, but that's not necessarily going to work into your favor.
So then, Marty, we touched on people that have credit, whether it's a 620 or 680 or 720 or whatever their score is. We talked about people with no credit, but what do I do if I have bad things on my credit? Now, unfortunately, a few of us might have like a few lates on our credit card or a charge off from the cell phone company, or of course, since the crash maybe in 2009 or so, definitely in California, I'm sure that you've come across this, they might have like a mortgage foreclosure or that kind of thing. What do those types of people do?
Well, there have been a lot of recent changes when it comes to underwriting I'm going to base on foreclosures here because that was the last thing that you said.
Right.
It does get sticky there. There are ways that we're able to obtain mortgages for people that have had foreclosures, but typically there needs to be extenuating circumstances. And I'll go back to the credit part for just in just a second. In extenuating circumstances, a spouse getting sick, a spouse passing away, job movement, all kinds of different factors, but they are very, very specific, and that can work out. But if we need to go and try to improve credit, there are ways to do that. There are many credit improvement companies out there. I would want to caution anyone who just calls up some random person to help with that. Hopefully you can get a recommendation from a professional that you trust and that you work with. And there are ways that you can go ahead and help clean up some of the erroneous items that are on there. And that's not to say that the borrower, that the consumer cannot do that themselves. However, it can be difficult navigating that. That's if there are incorrect information and stuff that we would want to have removed from a credit report. If they do have existing credit, Taylor, and the credit score is not going to make happen what the borrower wants to make happen, there are ways that we can help structure what they do currently have to increase their credit scores. Now, I'm gonna jump backwards for just a second, if I can. And we were talking about the amount of credit outstanding to the amount that people have available on their lines of credit. Okay. Now, for example, I'm going to go back to that $10,000 worth of credit. All right. If you have $10,000 worth of credit out there, outstanding, you owe, and it's all on one card, that's going to be tough. So there are ways that if you have multiple cards and might have a balance transfer option, that you could offload a portion from one to another and help balance it a little bit. So this is something that you can do. Ultimately, to obtain the best credit scores possible, you want to have a 0 to 30% outstanding of your credit limits. So we have ways where we can analyze and say, all right, if we take X number of dollars from this credit card account with blah, blah, blah bank and move it over, transfer balances to this other blah, blah, blah credit card, we can then reduce the risk and increase the credit score. So there are all kinds of ways to manipulate that. And when I say manipulate that, I do not mean that in a negative way. But there are ways to work within the system to get the increases that we would like to see in the scores.
Marty, that's a fantastic strategy. And I wanted to highlight one thing that you were talking about, and that's foreclosures. And I don't know if there's a definite time frame for this, but let's assume someone had a foreclosure and it's on their credit report. How long does it stay on their credit report, and how long will the lenders know, hey, it happened 5 years ago or 7 years ago or 2 years ago? At what point will they finally say, okay, that was a long time ago, why don't we start fresh again?
7 years and a day. And that's when I say 7 years and a day, that is the majority that is out there right now. That's Fannie Mae, that's Freddie Mac, that is, I don't want to say the majority of all large banks, but a good portion. I do have several lenders that are fine after a 4-year time frame. And again, there, like we talked about before, there are extenuating circumstances. So that can be rolled back to anywhere from just over a year, 3 years, 4 years. It honestly, Taylor, it really depends on the situation, the what happened, and what kind of loan we're looking to get.
Perfect. And then, Marty, I can't take up all your time today, even though I could talk to you forever. I would love to ask you one more question, and then maybe some action tips for our listeners. And then, of course, we're going to find the best ways to follow and connect with you. But I think this is a good way to kind of wrap it up just a little bit. And I know, Marty, that you are the loan guy. It's obvious. So let's delve into some of the do's and don'ts during the mortgage loan process. Maybe start with a few of the things that, if you're applying for a mortgage loan, definitely do not do this. And then maybe some things that you should do.
Okay. I want to preface this that the last 2 years of your credit history is more important than however many years prior to that. What you've done in the last 24 months is more indicative of how you will perform. Therefore, your credit scores are higher. That being said, okay, if you are going to be a first-time home buyer, you're going to be a move-up buyer, whatever it's going to be, you have a time frame, I'd start looking at everything about 6 months prior to that. And during this 6-month time frame that you're going to get into your new home possibly, you don't want to be applying for any new credit cards if you can help it, because you're going to create inquiries, and then you're also going to have brand new lines that don't have the seasoning, and I'm using air quotes on that. They don't have the history necessarily to view beyond that 6-month time frame. Is counterintuitive as this sounds, you don't want to pay off old collections or charge-offs. Okay? Why? Because then it shows up fresh again as a paid collection. And if it occurs within this 6-month time frame or this 2-year time frame, it's going to actually hit your credit scores and make them worse. And I know that doesn't sound right, but that's the way it works. You pay them, it then gets updated with a current date, and that creates more of a problem. Another thing that happens a lot is people say, oh, I have this old account, I haven't used it in so long, and they'll go ahead and they'll close out an old credit card. Okay? I understand people don't want to have them out there. However, what that does is it reduces the amount of available credit that you have. Okay? So if you have balances out and you've reduced your credit, the way these algorithms work is you are now a higher risk because you have a higher percentage of credit outstanding versus your credit available. So you do not want to pay off or close out any old accounts. And again, the older accounts, they give you history, and that adds into the 35% chunk of what we're dealing with. Also, the last thing you want to do is go and max out your credit cards. If you go and do that, that's going to bring you down 20, 30, 40 points, depending on what we're looking at. And as we've illustrated before, a differential of 40 points is going to cost you quite a bit over time. And I touched on it briefly also. You don't want to consolidate your credit cards or whatever to one or two. because when the credit bureaus look at the credit cards, you want to have them as spread out as possible with lower balances compared to the line limits. There are many, many more things that we can get into. I don't know how much more in depth you want me to go here, but those are generally what I recommend to my clients as we are going forward. And then also I want to suggest that people find a mortgage lending professional that they can trust, that they are very confident that they're being told exactly what they need to do, it's being suggested to them exactly what they need to do to improve their scores and to get themselves ready to be in the best possible position. And to me, that's the key, is having that personal connection with my clients and giving them the information, letting them choose how they wish to go about doing it. And when they want my opinion, I'll give it to them, or I can just guide them. It's kind of simple, but to me, that's the most important part for any of them.
Marty, it's a fantastic call and great breakdown on credit, a little bit about loans. So why don't we give listeners some final action steps or strategies that they should take right now?
Okay. If you are going to go out and be a first-time home buyer sometime in the next 12 months, or you're in a home that you've outgrown and you need more space for your family, prepare yourself now. Contact a mortgage person that is in your area or not in your area that you can get advice from, that you can go through, and check your credit out. Make sure that everything is in order. All right. You want to make sure that you clean everything up, and you want to go and sit down and be pre-approved for the numbers that you're looking for, or to find out exactly what you can afford. But those are essentially the steps. Obviously you want to be paying all of your bills on time. Any 30-day lates within a 12 or 6-month period are going to make significant hits to your credit score. So you want to be as perfect as you possibly can be. Again, Taylor, I could go on and on about this, but that would be my advice to people that are looking to do things relatively soon.
Marty, fantastic information. Obviously, you know your stuff. Anybody listening to this is crazy if they don't follow up with you. So, Marty, what are the best ways to follow and connect with you?
Okay, couple ways we can go here. I'm gonna start with my email, which is mgoldstein, which is GOLDSTEIN @gemcorp, GEMCORP.com. That is my email. Telephone number here at the office is area code 818-223-0900. I'm at extension 117. Our website is GEM Los Angeles. And those are the best ways to get in touch with me.
Fantastic information, Marty. And then, of course, as listeners know, they can also get your complete contact details at your show notes page, which is Marty Goldstein. But Marty, thank you so much for coming on today, talking about credit scores, talking about mortgage loans. I think it was fantastic, and I hope we can do it again sometime soon.
Taylor, I appreciate you having me. I love this opportunity. I love talking about this stuff. The educational process for buyers, especially first-time buyers, is very important to me, and I like being able to share it. Thank you again.
You heard me reveal before our call started, but I was so incredibly impressed with Marty's understanding the real correlation of credit score in relation to mortgage loans and obvious passion for his clients and business that we go further in depth with mortgage loans in future episodes. In the meantime, you can head on over to our site for complete show notes, easy ways to follow and connect with Marty, and more information about dealing with his fantastic mortgage business. And don't forget, if you're a homeowner, agent, or developer and want to showcase your properties to my listener base in over 70 countries, they invite you to list your properties with us. Head on over to irelpodcast.com/list to get started.
You have been listening to the IREL Podcast with Taylor White. Be sure to hit up IRELpodcast.com for more. That's IRELpodcast.com. Thanks for listening.